QSBS, the Qualified Small Business Stock Exemption, we think of this as the best tax break around. There are very few 100% tax exemptions. The bill has changed the landscape significantly. So anyone who is founding a company, investing in a company at the early stage, or joining, which is a lot of you, you're going to be able to take advantage of this. So I put $1 million into a solar project. I'm typically getting back a tax credit of around $800,000, a credit being an actual reduction of my tax bill. So dollar for dollar. That's obviously massive. We often get the astute question, this administration isn't super happy with renewable energy. What happened in July? Is this no longer viable? And the answer is actually, not only is it viable, but it was ensconced in law in a way that now it's not going away until it sunsets. And the benefits were actually increased because this is seen in general as a pro-business program. The major improvement that this bill included is across the board for all businesses. The big bill instituted or reinstituted 100% bonus depreciation. Now, for solar projects, renewable energy projects, among other business projects, you can deduct 100% of the value of the project in the first year. And I didn't even bring any math here. I can just tell you that is massive. If you put $1 million into a solar project, it's worth $2 million. You get to deduct, there's a little bit of math here, but you get to deduct like $1.65 million from your W-2 income. Add that to the credit, and for every dollar that you put into one of these projects, you're getting back between $1.30 and $1.80, plus all that revenue. You can do your research, read up on this. It's not well known, and yet the industry is growing massively. This is a very positive thing. It is so positive that it is time limited, right? Congress wanted to do this, but understands that we're spending billions, hundreds of billions of dollars on these incentives, and it's not around forever. Very importantly, the bill clarified something that was already true, but not obvious to a lot of people, which is that limitation applies only to the year in which you make your purchase or investment. And that's true across solar and hedge funds and real estate. If you have much, much more depreciation from any of these kinds of things that you're doing, it carries over above that limit. It carries over to next year, and next year, and then up to 20 years. You can take that deduction up to 80% of your adjusted gross income. To qualify to use your solar benefits against your W-2, you need to be what's called a material participant, which means very, very shorthand here. There's a lot more to it, but shorthand is you have to spend 100 hours working actively in the solar business during the year that you claim the tax benefits. And with oil and gas, there's no such requirement.
The next 25K is going to be fully loaded taxed in California this year at less than 30%. As their income increases, there's a point where they're actually at 525, the next 25K, they're going to pay more in taxes. Like, how does that make sense, right? Like, how does that, I mean, we're not going to have time to, we can maybe stick around later, but the point is that as your income goes up, tax preferences unwind, and you don't want to be caught on the wrong side of a phase out like this is the idea. Here's what's happening with AMT that's not understood yet very well at all. These phase out regions get squished. So here's the thing, if you're single, you're either going to have a phase out because of the salt that you lose, or if you're triggering AMT, you're going to have a 50 cents on the dollar phase out in this range right here. Instead of having that 37.1% max tax rate, as your income goes up here, you could be losing more than 50 cents on the dollar. So planning matters. There's some good news. You can be retired and pay zero taxes. Welcome to part 5 in our installment on this Accredited Investor Networking series. Part 1, actually, Jeff was one of our first speakers, and he was the most popular breakout, like that, and the AQR one. He talked about charitable trusts, but they actually do a lot more than that at their firm. So when the new tax bill came out, I thought it would be awesome if we can get Jeff to come back, and he was gracious enough to join us. So Jeff's here to talk about the investment related implications of OBBBA. That's the tax bill, the budget reconciliation bill that had a lot of tax changes in it. So that's kind of our focus. That's kind of one way of bracketing it. And we'll do some more intros here, but I do want to take a moment to just kind of remind you guys to check out the FinTrack page. We got some great events coming up. So this is today. If you guys can see my screen, this is at the end of the month. It is a hosted event on monetary policy with a professor emeritus from UC Berkeley and an alum, Hartley West. That's at the end of that's in October 30th, just before Halloween. And then we're excited about in 3 weeks, exactly 3 weeks, we're kicking off a financial engineering series. It's a 3-part series. Part one, it's going to be limited to hedging and really examples of technology that was a part of MIT, the Black-Scholes Merton pricing model, and some pretty cool stuff going on in that field. And then so that's November. December, we've got Professor Lowe coming out. So save the date. We just booked this December 10th. He is the director of the Financial Engineering Lab. Financing deep tech is a big part of what he's been doing. So AI obviously is an interesting topic that overlaps. So there you go. Sign up, get in on. I think we got this one's not posted yet, and we still have free tickets for these, and they're all available on Zoom. And so there you have it. All right. So I'm the FinTrack lead. My name is Jason Escamilla. Been doing this for about 5 years with the club. Been in finance my whole career. Love this stuff. Love doing events. If there's other people that have interest in joining, just email us, get involved. A little bit. I guess my background is kind of a tax nerd when I was in high school. Do wealth management. I was a freshman. My first job, I got squeezed out by the computers. I was a certified tax preparer, and then some software came out in 1987, and I got let go. But that's how life is, man. So I'll talk more about taxes later. I'll turn it over to Shang now, and to introduce himself, and then pass it over to Jeff. Take it away, Shang.
Yeah, thank you, Jason. I was going to say nerds rule, we're all nerds here. So great to see everyone. Quick background on myself, class of '04 at MIT. I'm active with the MIT Club of Southern California, based here in LA. Professionally, I'm the co-founder and managing partner of a family office and alternative investment firm. We're super delighted to have everyone today. We have Jeff Love from Valor. Jeff serves as the head of product of the firm, and Valor is a fintech that focuses on tax planning and wealth management. So it's going to be a great discussion. Jeff himself is a graduate of Stanford and Yale Law. And one thing I'll say as well is we want to keep this interactive. So feel free to use the chat box and drop in questions. We'll take them in real time, and we'll probably, if we have time afterwards, we can do some breakout rooms and things like that. But maybe just to tee it up, obviously we're all aware that the one big beautiful bill. So, assuming most all of us here are either thinking of starting a business or joining a startup or investing in a new business or startup, what are some things that we all should know? So maybe with that, Jeff, I'll turn it over to you.
Yeah, I appreciate that, and you've teed up the right question or the right way that we think about this. Valor, I won't talk a lot about Valor here. I want to focus on the bill and the solutions, but
Well, hey Jeff,
Valor.
let me cut in. Let me just cut in. You guys he doesn't need Valor has a bird's eye seat on cool stuff going on in taxes, and that's why Jeff's here.
This is
So
where we
check it
come
out for
from.
yourself.
No, that's fair. We come out of Silicon Valley. We think a lot about early employees, about founders, about investors. But we've expanded over the years, and really, even since I spoke to this group last, we've reached a bunch more people, and we now talk to public stock investors, crypto investors, small business owners, and so we do have a bird's eye view. And there's a lot to talk about here. This bill was massive. It was plenary. There's a lot that I'm not going to talk about today, although I'm happy to answer questions and dig in if people want to. But I'm going to focus on a couple of topics that are core to how we help people. And the reason that they are central to what we do is that they are, in some ways, the first stop or the lowest hanging fruit. These are the things that the widest group of very successful, high earning people like this group and like our clients can take advantage of. And so we can take a look at a few different categories, and then of course dig in further if everybody wants to. So you all can see my deck right here, Jason.
And I'm going to jump in one more time. So guys, this is recorded, as you know, but what we're going to do is turn off the recording for the interactive Q&A. And we've also got an alum, a classmate of mine from MBA 02, Paul Strasman is gonna, he's actually been like knee, shoulder deep in solar and investing all year. So there's a lot to learn about from people that are doing it. So stay tuned for that. That also won't be recorded. So stick around if you want to hear about that part. And then back to you, Jeff.
Appreciate it, Jason. The agenda here is very loose. I'm going to be talking about a couple of categories here. I'm going to be focusing on what I think of as kind of the life cycle of the kinds of folks who are here to listen to this today and who think about investing, starting from, as Sheng teed it up, the earliest stages of being involved in a company. This is something that comes up a lot, and I'm sure a lot of you have been involved in startups as founders, as employees, as investors. I'm going to talk about kind of the context of what high earners can do, what you can take advantage of as a result of this bill, as your career has developed and as your roles have developed. I'm going to talk a little bit about the end of life and estate tax planning just for a minute to let everybody know kind of what's out there and what has changed. And then, throughout, Jason's going to jump in at one point. There are some kind of complexities around things like the AMT, alternative minimum tax, things like excess business losses that span these categories, but are going to be very relevant to you all, even if you don't necessarily realize it quite yet. So first up is what I think of as that very earliest stage. You're founding a company, you're investing as an angel investor, or as an LP, or even as a professional investor. You're joining a company in the early days, and I'll define what I mean by early. Or you're founding a company, and the question is, what's the state of play? How did the bill change what it means to be a founder, early employee, early investor, and how can you take advantage of those changes to maximize your long-term returns? So very quickly, I think many of you will know this, but it's not something that comes up in day-to-day investing. So I'll make sure we're on the same page. QSBS, the Qualified Small Business Stock Exemption, might also hear it referred to as the 1202 exemption from the code provision that defines it. This is, we think of this as the best tax break around. There are very few 100% tax exemptions in the US tax code. This is one of them. And the way this works is that for anyone who receives shares of a very small or a small company, either by founding it, by joining as an employee, or by investing in it before a certain point, and I'll talk about that, a bunch of your capital gains are tax-free. It used to be that the first $10 million of your capital gains were federally tax-free and also tax-free in 46 states. California is not one of them, which is unfortunate for those residents. But most places, you're completely tax-free if you found a company or join early and then sell your capital gains, given that you've met certain requirements. That's a massive tax break. It's something that it requires a little bit of planning, not a ton, but that you can take advantage of down the road, and that's huge. So $10 million of gains used to be tax-free. You used to have to hold those shares for 5 full years to get this exemption, and you had to receive the shares when the company was small, meaning that it had less than $50 million of enterprise value, right? Not a tiny company, but if you were a venture-backed startup, as an example, and you had raised a couple of rounds, in the old world, you were going to cross that threshold, and later employees and investors were not going to get this benefit. The bill has changed the landscape significantly. So anyone who is founding a company, investing in a company at the early stage, or joining, which is a lot of you, it was me 5 years ago when I helped start and joined Valor, you're going to be able to take advantage of this. So what's changed? The first and maybe most important thing is that now, instead of $10 million of your capital gains being exempted, it's 15. So if you found a company and you hold your shares for a certain amount of time, $15 million of capital gains, totally tax-free. That is so rare in the code, and it's something that really should, in my view, be driving your planning at the founding stage. You want to make sure that you're doing everything you can to set yourself and your company up to take advantage of this benefit. There are trade-offs and compromises that we can talk about, but it's something that anytime a founder comes to us and asks, what should I be doing? The first thing is think about whether you want to go after the QSBS exemption. And if so, make sure that you do everything right. So 15 million totally tax-free at the federal level and most states. The second kind of key provision here that used to be a significant limitation and is now less so, as I said, is that it used to be that if you received your shares after the company was worth $50 million or had raised $50 million or had $50 million of enterprise value, it was too late. You couldn't claim the QSBS exemption. In the heady days of like 2015 to 2021, that date came very quickly. Companies were raising their, Series A round at $100 million valuation reasonably soon after founding. Things have calmed a little bit, although you see green shoots in the market. But still, it's reasonably easy for companies these days to get to a $50 million enterprise value. The bill increases that number to 75. So now you have a little more runway. And if you think about the traditional kind of cadence of fundraising for startups and other small companies, 75 million of enterprise value tends to come a little bit later, which means that employees who join up to, the Series A, maybe even the Series B, get this protection. And so as a founder, as an employee, or even if you're writing a check as an investor, you've got more leeway to get in later in the game and still claim this benefit. And then I guess the last main change here, there's a lot to this, and I can slow down. We can talk about the other kind of qualification points, but maybe the most impactful change day to day here is it used to be that in order to claim this benefit, if I founded a company or I joined at the seed stage, I had to exercise my options if I received options or receive my shares, and then hold the shares for 5 full years to get any of this exemption. If I sold before 5 years, by even 1 day, then none of my gains would be exempt. That's no longer the case. The change here is both to shorten by phasing in that requirement. So now, instead of a hard binary 5-year marker, we now have a phase in where if you sell your shares after you've held for 3 years, you get half of your gains tax-free. If you hold for 4 years, you get 75% of your gains tax-free. And if you hold for 5 years, just like in the old world, you get all of your gains, up to $15 million now, tax-free. So this is reasonably technical. Stepping back, the point here is if you're founding a company, if you're joining a company, if you're investing, you want to think about, ask your lawyers about, and or ask the company you're investing in about QSBS qualification. Make sure that you are taking the appropriate steps to exercise, to own your shares, and that you have an eye on these date and quantity thresholds so that you don't get caught, for example, selling your company a year too early and not getting this benefit. The changes here have made this much more widely applicable, easier to qualify for, but still, you got to be careful. And this is, like I said, the most impactful thing you can do with a startup, and so important to pay close attention to.
Hey, Jeff, did you want to cover like kind of some of the more edge cases or interesting cases where you can reinvest in another? I was just actually talking last night about this, about, the older shares where that's a 50%, and the idea of reinvesting into another QSBS to defer or roll your gain. So you got that piece, which is commonly missed. And the other one on the 5-year rule, if you're part of the old 5-year rule, how hard is it to find another place you can actually extend and continue your holding period to get to 5 years? If maybe you found another company yourself, maybe that's been your plan, but if you do it, you have to do it within a certain time range. Are you comfortable talking about that?
Yeah, I can talk about that at a high level for sure. Let me answer Daniel's question first because it's an easy one. Daniel asks, is the new QSBS rule retroactive, or does it only apply to stock after a certain date? Critical question and a clear one to answer. these new rules apply only to shares that were received by the company, either because you've founded it or joined or invested after July 4th, 2025. So I'm a good example of this. I joined Valor way back in 2020, received a bunch of shares. I still hold those shares. Those shares are governed by the old rules. I received a new tranche of refresher grants in August, and those shares are eligible under the new rules. Okay, so if somebody founded a company in June, then unless something changes, they're out of luck. They're under the old rules. And we work with a number of companies where, they did their paperwork in late June and they haven't gotten traction yet. They haven't really rolled out. And there are ways to go back and kind of clean this up. But in general, yes, it only applies to shares received after that date. Blaze asks how this works with safe investments. That is a complicated question, Blaze. There's a split of authority on whether investing in a safe is the date of signing that safe is the relevant date for the 5-year, not the 3-year clock, or whether you have to exercise the safe in order to start that clock. This certainly applies. And so if you invest in a safe at the early stage, you will eventually get QSBS treatment if you hold your shares for 5 years. Whether that's 5 years from purchase or 5 years from conversion in an equity round is up in the air, and you should definitely talk to your own accountants and lawyers to see how they feel about it. This is one of the few things where there's really almost an even split of authority. Usually, I can tell you that 3/4 of accountants and lawyers agree. This is one where it's really, really not clear. So talk to your lawyers. To talk about Jason's question for a second before I move to the next topic. Very often, and Paul flagged himself here as an example, very often you're stuck. You've gotten interest from a strategic acquirer or from private equity, or you've just gone to market, and things move more quickly than you expected, or you didn't know about this and you're in a position to sell before 5 years. That's not uncommon to do a secondary round and want to sell some shares or to be acquired. And the question is, well, what can I do about that? There are a few things, right? Jason, before we talk about the kind of more creative technical ways to extend your runway, one thing you can do is structure your deal around the right dates, right? Sell in tranches, structure it in a way that fits with these rules. That's a lawyer question that you should dig into. I can't tell you exactly how that would work with your deal, but in general, if you know about this, you can plan around it, right? But still, sometimes you get caught, right? You end up having to sell. The buyer absolutely wants to close by a certain date, and that's before your 5-year mark or your 3-year mark. Something you can do, and what Jason flagged, is there's a rollover provision here. This is analogous to something that you all might be more familiar with, some of you might be more familiar with which is the idea of a 1031 exchange in real estate, where you sell the real estate and you roll the resulting funds into a new qualified purchase, and you don't have to pay tax, right? It treats it as though it wasn't a realization event. Similarly here, if you take the proceeds from your QSBS eligible sale, except that you're too early, so it's not eligible because of that date, you can roll those proceeds into another qualified small business, and what's called tack your 5-year or tack your period, which means just continue counting from that date. And so there are all kinds of schemes here, and I use that word as pejorative, and I kind of mean it that way. There are all kinds of schemes to try to help people roll over their QSBS via strategic investment in other QSBS eligible companies that aren't truly operating companies. That's a cautionary tale. What you can do and what people do is find an actual investment to make, right? If I take my proceeds, say I make $1 million of money that would otherwise be QSBS eligible from the sale of my business, I can take that $1 million and spread it across a number of angel investments, all of which are QSBS eligible, and extend that time. Another thing you could do, Jason mentioned, is you can found your own company and invest your proceeds there. broadly speaking, we don't recommend that you let that move kind of determine things for you because it is fraught. It is challenging technically, legally. It's doable, but there are downsides, right? If you invest in a new company and that company goes bust, well, you don't get any of the money. Whereas if you had just taken your tax pill, you would have kept 70%. So it's not for everybody. You really have to believe in what you're rolling this into. But it is absolutely something you should think about if you do come up a few months or a few years short. Looking quickly at the questions before I move on.
And
You
hey,
said the
Jeff,
new
why don't we
yeah,
release the poll results and
yeah, please.
let me know if you see them because you're our headliner here. I want you to kind of absorb it for the audience. And I'm gonna end the poll and we're gonna share the results. And so the trick is they might be behind your screen, everybody. And let me know when you can see them, Jeff. If does that and are you able to kind of read through for the people that are riding a
I
motorcycle while
can.
doing this?
Yeah, absolutely. And I can tell you that this is, I could have probably you, Jason, could have too, Shane. Really, anyone could have predicted the breakdown here. This is you all are a sophisticated group, but some of this stuff is esoteric. And so, starting with the first category, how familiar are you with this bill, the OBBBA? And the answer is, about half of you, a little more than half, are generally familiar. A couple of you have done deep research, and a few of you just weren't really aware at all, which is about right. Most of these things are kind of a normal curve, right? Even for the sophisticated group, not everybody's spending deep time learning about this stuff, and we'll talk more about it. The second category, what's your investment profile? What kind of person are you? A few of you are not yet accredited, which means you're kind of starting your journey, getting there, and there's plenty here that we can talk about, even if you're not there yet. Again, about half of you are accredited investors, which is, yeah, the hump of the curve. It's the most common profile for MIT alums of around everybody's age here, right? You're making somewhere north of $200,000 or $300,000, got $1 million of assets. You've established yourself. You're not yet what's called a qualified purchaser, 5 million plus of investable assets, which is about a quarter of the group here. And another 20% or so are retired. So congratulations, keeping a low tax profile. Again, that makes sense, right? This group is sophisticated, knows what they're doing, and is established, and so a bunch of accredited investors who have the entire panoply of options at your fingertips that we'll talk about. What kind of income do you earn? Always an interesting one. There's a little more variation here usually. What I'm seeing here is that about half of you earn W-2 incomes. About half of you are self-employed. Now there's overlap between self-employed and owning a business. About half of you said you owned a business. Maybe a third of you own alternative assets, and half of you own public stock and have capital gains. I'm guessing that what that means is that about half of you have actual income from public stock. I assume that almost everyone here owns public stock. That's just these days kind of table stakes and reasonably common. All of these, by the way, are relevant to the next couple of slides. I'm conscious of the time, and I'll get there. There are going to be things here for W-2 earners, business owners. Those two categories are often the hardest to plan for. They have the fewest options, but this bill actually ensconces a couple of really important things that are available. And then public investors, private assets, these are kind of the classic groups that have tax options. And so we'll talk about those. And within those categories, looks like, yeah, almost all of you own traditional investments. Interestingly, 2/3 of you own real estate. Maybe that includes primary homes, so maybe that's not that surprising. A third of you own, are interested in. A third of you are interested in solar and renewable energy. I think that number will tick up after I talk a little more about how the bill affected the renewables industry. Fewer of you interested in oil and gas, which tracks. It's a more kind of exotic thing that people don't talk about much. And then, a third of you or so are interested in hedge funds, in charitable trusts, which I talk a lot about. Some of you heard me last time. And in 351 exchanges, which are a reasonably newfangled vehicle for tax reduction. So again, you all look like an educated, sophisticated group that has room to learn more. and take advantage of a bunch of the things that I'm going to talk about on the next 2 or 3 slides. So Jason, anything you want to add there?
No, actually, that's great. Yeah, no, thanks. I had some thoughts before, but I've already forgotten them. So no, keep on.
No,
Yeah,
that's
keep
fine.
on going.
I'm
Shang,
gonna,
but let's
oh
give
yeah,
Shang a chance. Shang, you got any comments in there too,
Sounds
man? So
good.
Shang,
Let's keep moving.
down
Yeah.
there from Southern California.
Nothing for me. This is great. Yeah.
yeah. I'll take one more question on QSBS because I see it and I can't help myself. C Corp, LLC, etc. Definitely has to be a C Corp. You all should just go and if you Google Valor QSBS, or honestly just Google QSBS, you'll see plenty of articles on qualification. It's got to be a C Corp. And importantly, it can't be a services business. So consulting, even if you set up as a C Corp, doesn't fly. This is for traditional, just a little bit of background here. The QSBS exemption was the product of the late 90s .com boom. Congress decided they wanted more startup founding and investing in the US, and so implemented this strong benefit really for startup software startups. And of course, over time, others who didn't quite fall into that category attempted to stretch it and pull on it. And so we have, coverage of a lot more groups, not just traditional startups, not just traditional software companies, but it's not for law firms, banks, consulting companies. So,
And while you're doing that, Jeff, so we had one question came in, really kind of a follow up from our part 1 series where you covered charitable trusts.
yeah.
And
Yeah.
so as we transition to this next section, we had a question from Anu. What, if anything, has changed for CRTs, charitable trusts, as a result of OBBBA? And we're not going to go deep into it, but
Yeah.
that's kind of our bridge question from previous that gets us to here talking to you again.
Let me do one beat on that, and then I'm going to circle back to it. Nothing has changed with respect to the structures that supercharge charitable giving as an investment strategy. So charitable remainder trusts look the same as they did before this. They look the same as they did more or less in 1968 when they were implemented. And they honestly look quite similar to how they looked in the year 1215, literally, when the church invented them in England. That hasn't changed. Charitable lead trusts haven't changed. What has changed, and I'll jump ahead a little bit here, is how charitable giving is treated generally with respect to deductions. And then to Anu's question here, how top university endowments are taxed, and we talk to these gift offices all the time, and I have some insight into what that means for the alumni of those universities with respect to their giving. So I'll just do this slide now. Why not? Big picture, the changes, aside from the endowment, the changes all are fairly marginal and at the very low level of charitable giving, the kind of giving that everyone kind of does, the hundreds and a couple $1,000s here and there. The idea is that the limits or the kind of the lower bound on itemizing of deductions has changed a little bit. Now people who claim the standard deduction and don't itemize can claim some charitable deductions. For most higher earners who are itemizing, you now can only claim an itemized deduction if you're giving over 0.5% of your adjusted gross income. Those are all really marginal changes that you should be aware of because it'll affect how you do your taxes next year. It doesn't really affect this kind of large scale charitable giving. What does affect you all, to the extent that you are involved in giving to MIT or other places, is this endowment tax. This was a focus of this administration. No particular comment on that policy development, other than to say the administration and Congress decided that they were going to increase the tax aggressively on the top 50 or so university endowments. And there's a sliding scale, and so really most universities are affected a little bit. MIT, Stanford, Yale, all of our universities are affected quite a bit. The tax on those endowments has gone up substantially. That eats into the amount of money that's available every year. And so what we're hearing is that and really just more broadly, the cuts in federal funding, the various policy changes that have eaten into these very large endowments and that then trickle down to the smaller endowments as well. We do a lot of work with universities in that second tier, Carnegie Mellon and the like. The impact this has had is twofold, and it cuts both ways. One is giving is more important than ever. And so we've seen a renewed push to bring in dollars any way possible. And charitable remainder trusts are a really powerful way for gift offices to do that. Because, to refresh everybody's recollection, or for the folks who haven't heard this before, charitable trusts are a way for you, the investor, to give some assets, eventually to commit some assets to a charity, but in the meantime, to benefit substantially from their growth. And so the way this works is you take some Apple stock or some cash or whatever, and you put it into a trust. You get to reinvest it. You get a small deduction up front, but then the money inside the trust grows tax-free, just like if it were in an IRA or a 401k. And you get to take money out every year. And so the way this has worked for a long time for universities is I, the alum, will put $1 million into a CRUT, a charitable remainder trust. I'll reinvest it. I'll take my 8% per year. And as that grows, that number gets bigger. And so I have a nice annuity coming to me, for lack of a better word, $100,000, $200,000 a year. And then when I pass away, or let's say in 20 years, if I set up a term trust, the university gets what's left in the trust. And that's a good way for me to get the social benefit of committing money to my university or to any other charitable institution now. But I don't actually have to give it over, and I don't have to kind of give up the benefit of compounding and of growth until way down the road, potentially after I die. That is still a powerful tool, and the universities are using these maybe more than ever as a way to encourage even long-term gifting as a result of these of their reduced endowments. That being said, there's also a renewed effort and maybe an increased, I don't know, social benefit. The gift offices are really trying to encourage early giving now, because endowments have been affected substantially already. You know, I don't really think that affects the individuals. It's still a choice. It's not like the universities are turning down long-term gifts by any means. But whereas in the old days, you know, an MIT or a Harvard or a Stanford might have been fully indifferent to immediate gifting and longer term gifting, their discount rate's not very high, and they're happy to take money down the road. Their bottom lines have been impacted, and so they're pushing a little more for early gifting. So anyway, I hope that answers your question. Big picture, though, is that charitable trusts are a really powerful way for investors to increase their bottom line, their overall returns, while also, as I said, getting the benefit of announcing to the world that they're going to be giving to charity down the road. And so Valor does a lot of this. About 2/3 of our business is charitable trust, just because it's a really, really powerful thing. And so if you, just to kind of put a fine point on it, if you like the idea of giving, fantastic. But even if you are indifferent to giving, you know, now or later, if you've got an asset that's grown 100% or more, you bought some Apple stock in 2010, or you got some startup equity, you bought some crypto, or even you bought Nvidia a year ago. This is a way for you to recognize those gains without the massive tax hit that would typically come along, while also, as I said, committing some to a charity or an institution that you care about.
This email went out yesterday, guys. There's a MIT Office of Gift Planning also doing an event next week on Wednesday. So charitable giving, and if there's a volunteer that wants to organize an event where we can pick up the subject again, let's. I know there's interest. But yeah,
I'll just say, if you're considering doing this with MIT, we've worked with the MIT Gift Office. We can set up those trusts and do it in a way that works for MIT and works for you. So happy to help. But especially for, you know, kind of folks my age, you know, plus or minus 10 years, you're still early in your journey. Maybe you're not ready to write that $1 million check. We see a lot of people around this age doing this charitable trust strategy as a way, again, to get the social benefit of being one of those big donors without having to do it right away. So I will quickly move on and happy to circle back to that if there are questions. I'll do 10 minutes on renewable energy, and then we can see where we are, if that makes sense.
Yeah, let's do that. Let's roll. That'll set up for Paul's
That's right.
sharing. We'll go over AMT, and then we'll get your hands warmed up, guys, if you wanted to raise them.
So renewable energy. This feels esoteric. It's kind of an off the wall thing, but it is incredibly popular right now and has been for the last 5 years or so. And so definitely wanted to hit on it. The question I've posed here, which is I think relevant to most of you, is I'm a high earner or business owner. How can I reduce my ordinary income taxes or my business taxes? This is something that is very difficult to do. The IRS is very good at getting its hooks into earned income, W-2, RSUs, business income. Not, the business side, there are more deductions, but still, you're not taking a massive chunk out of your personal earnings. W-2, it's almost impossible unless you pursue the kinds of things that Congress has laid out to incentivize via creative tax moves. So the idea here is that Congress and the states over the years have had an interest in incentivizing investment in renewable energy infrastructure, specifically solar, but also electric vehicle infrastructure, charging stations, wind. This administration is less interested in wind, but solar and EV charging, battery storage, these are the things that really in a bipartisan way, the establishment has an interest in incentivizing. And the way they've chosen to do that is with a series of very aggressive tax breaks. So at a very high level, before I talk about the bill, how this works is, let's say that you or I go out and purchase, invest in, fund the building, the construction of a solar array on the roof of an apartment building. Not a building that I own or that I live in, but just a project, an infrastructure project out in the world, or it's on the roof of a community building or a hockey rink, or a university. In exchange for funding that project, I get several very large, I'm just putting my email into the chat, several very large tax benefits. I'm not going to go deep on this, but just so you have this in front of you, the first benefit is a tax credit, which through some fancy structuring, and I won't go too deep on this, but through some fancy structuring, typically lands around 80% of what you put into these projects. So if I buy or fund a $1 million solar project, or I put $1 million into a solar project, I'm typically getting back a tax credit of around $800,000. A credit being an actual reduction of my tax bill, so dollar for dollar. That's obviously massive. I'm getting almost all of my money back just via that credit. Also, this is a physical infrastructure project, just like real estate, just like other things. And as a result, the IRS allows you to deduct depreciation. That is the diminution in value of the project over time. That's, if you're putting $1 million in, the project is worth $2 million, you get to deduct a ton of money off of your W-2 income. Then there's revenue. You own this project, it's producing electricity, you're selling it, you're making money. This is a very positive thing. It is so positive that it is time limited, right? Congress wanted to do this, but understands that we're spending billions, hundreds of billions of dollars on these incentives, and it's not around forever. This program was scheduled to sunset at the end of 2032 as a result of the Inflation Reduction Act in 2022. What happened under the new bill in July is, in my view, actually encouraging. We often get the astute question, this administration isn't super happy with renewable energy. What happened in July? Is this no longer viable? And the answer is, actually, not only is it viable, but it was ensconced in law in a way that now it's not going away until it sunsets. And the benefits were actually increased because this is seen in general as a pro-business program. And so first thing to understand is that whereas this was supposed to sunset at the end of 2032, it now is sunsetting somewhere between 2027 and 2030, depending on the type of project. But Valor will be doing this, and we're building our business around the idea of facilitating these projects all the way through 2030, at which point we will have had at least 2 elections, and who knows what the policy environment is going to be. But you've got this at least through 2030, right? If the Republican Party with a trifecta and passing this massive bill, this was the most they could carve out. This is the floor. This is here to stay. And then the question is, what does it look like going forward? So it's here through 2030. The major improvement that this bill included is across the board for all businesses. The big bill instituted or reinstituted 100% bonus depreciation. And what that means is in the old world, when you owned a physical asset, you got to deduct the depreciation of that asset over an extended period, right? When you're buying a house that's 27 and a half years, when you bought physical infrastructure for a business, there were a variety of terms depending on, what it was and what kind of business it was. Now, for solar projects, renewable energy projects, among other business projects, you can deduct 100% of the value of the project in the first year. And I didn't even bring any math here. I can just tell you that is massive. If you put $1 million into a solar project, it's worth $2 million. You get to deduct, not there's a little bit of math here, but you get to deduct like $1.65 million from your W-2 income. Add that to the credit, and for every dollar that you put into one of these projects, you're getting back between $1.30 and $1.80, plus all that revenue. You can do your research, read up on this. It's not well known, and yet the industry is growing massively. Valor alone will do about $200 million of these deals this year. The industry as a whole is building billions of dollars of solar projects subject to these credits every year. This is becoming more and more known and more mainstream. And so our median client is just a high earning tech employee making $1 million or $2 million a year, doing very well for themselves, right? In the 1%, but not businesses, not huge earners. Just you're making good money, and you can put 100, 200 grand into solar and reduce your tax bill. And the July bill made that even easier than it used to be.
Hey, Jeff, this is a good chance, since you mentioned the deductions or the losses that appear. Can you talk about EBL or excess business loss limits right now? Or let's kind of check that box, and then we can talk more about these subjects at Q&A or after the hour, folks, but we want to make sure we get them all covered.
Yeah, I'm going to talk about it using solar as the jumping off point. It's a broader topic, as maybe you can fill in, Jason. It applies to a number of business-oriented assets, but solar is a good context. So the excess business loss limitation that Jason's referring to is the idea, and the bill made this limitation permanent. It was supposed to sunset in 2028. Individuals, non-businesses, and non-business owners, but people who earn W-2 income, 1099, even investment income, there's a limit on how much depreciation you can take every year from this sort of business loss, business depreciation. The max is about $313,000 for an individual, or $626,000, I think it is, for a married couple. And so what that means is you feel like if your depreciation is limited, then the amount that you can justify putting into these projects or other kinds of businesses, real estate, hedge funds, is going to be limited, because if you can only take a certain deduction, maybe the ROI of these things isn't as large. Very importantly, the bill clarified something that was already true but not obvious to a lot of people, which is that limitation applies only to the year in which you make your purchase or investment. And that's true across solar and hedge funds and real estate. If I buy, and we have clients who have done this, clients who are earning, one client earned $35 million from the sale of RSUs from a late stage private company. His tax bill is going to be $16 million. And he was bummed to find out that the max depreciation he could take is $626,000. It turns out that that's true only this year, and that if you have much more depreciation from any of these kinds of things that you're doing, it carries over above that limit. It carries over to next year, and next year, and then up to 20 years. You can take that deduction up to 80% of your adjusted gross income. And so while you're strictly limited in the first year, and that kind of diminishes the value of all of these types of projects, if you're willing to stomach the loss of the time value of money a little bit, right? If you'll hold over to year 2, you could end up with millions of dollars of tax deductions from this kind of thing. So as an example, again, if I made $10 million this year, and I put $5 million into solar, and that $5 million yields $8 million of depreciation. I can only use $626,000 of that depreciation this year, but I still have 7.5 million or so that rolls over. And then next year, if I earn 10 million again, I can use up to 8 million next year and take advantage of this massive, massive break. Um, uh, um, so Jason, I know this was your topic. Do you want to add maybe outside the context of
Well, it
solar?
also applies if you, let's say your spouse starts a business or you start a business. And there's a lot of, and it's the type of business that has passed through depreciation as an example, this limit comes into play, or it can limit your first year benefit, whether it's solar deals, there's hedge funds that provide this benefit. It's pretty interesting. I mean, with anything with taxes, it's like there are tax preferences, they come with rules, and you gotta have all the if then statements just right. So, but maybe you're thinking about getting married next year. Maybe get married this year if one person has a lot of losses and the other person has a lot of gains. So let us know if that changes anyone's plans out there. So all right, that's all I got.
Paul mentioned there's an interplay. Paul, tell me if this is what you meant. In general, the more depreciation you take in a given year, the smaller your or rather, the more credit you take, the smaller the depreciation you get from a project. Paul, I don't know if that was what you were thinking or if there was something else. I don't know if you're.
So specifically, this comes into sizing of a deal. You're putting in equity, loans are taken, that gives the project size. The project size determines how much depreciation can pass through to your income, which is affected by this EBL, and how much you can take this year versus carry forward. And because you've reduced your income, you may run into limits on how much of the tax credit you can take. And the mind-blowing thing for me was finding out that I could carry back the tax credit to prior years when we paid a whole bunch of W-2 income.
Yeah, that's right. Carry back. And then also, given this net operating loss kind of transformation, also carry forward, right? Now, if you've got a bunch of excess depreciation in that balance between credit and depreciation, you've got the chance to use a lot of it next year. And for our, a bunch of families that are earning 1 to 2 million a year, all of whom were aiming for the very low end of purchase size because they didn't want to go over that depreciation limit. Now understanding they can use most of that next year, it unlocks a lot of things. Again, I don't mean to be focusing too much on the actual buying of these projects, more the policy and the plan. But this is one of the things that we get very excited about because it really is the only compliant game in town when it comes to significantly reducing the tax on your W-2 income.
That was a little spoiler alert on what's coming after the hour, but there you have it. So we'll come back to that.
Yeah.
So
Jason, I was just gonna say I have like a minute on estate tax. We can skip that. I can be done if you wanna take questions or move to Paul. You tell me where to go next.
So we got to cover some AMT changes, and then yeah, we can hit the estate. Did you anything you want to say real quick? I think most people have heard already. Was there something that they might not have heard?
No, nothing huge here. This was really 1 minute just to let everybody know that things developed a little bit. The $15 million per person exemption was made permanent, which has some implications for how you plan for the next generation and end of life. Nothing nearly as actionable as the other stuff, so we can leave it at that.
Cool. All right, let's go. Let me switch to, I'm going to share my screen now. All right, so there's an important concept called phase outs in taxes. And I haven't successfully explained this to anyone quickly yet. So this is an experiment, but let's give it a go. All right, so there's some changes coming. And so I guess the simplest way to go is let's just take it one step at a time here. Let's show an example of a phase out. All right, so what we've got here, I have a tax calculator with an individual. So this is 2025, self-employed, just pure Schedule C, married, 3 kids. And this shows you how much their marginal tax rate. So they're sitting at the next 25K is going to be fully loaded taxed in California this year at less than 30%. If as their income increases, there's a point where they're actually at 525, the next 25K, they're going to pay more in taxes if they actually report that income. And like, how does that make sense, right? Like how does that, I mean, we're not gonna have time to, we can maybe stick around later, but the point is that as your income goes up, tax preferences unwind, and you don't want to be caught on the wrong side of a phase out like this is the idea. You could have put a lot of money into retirement, could have, your client drops you a check in the mail, you could be in this situation. So that's high level, the significance of a phase out. Here's another example. Let's say you're single, make 300K, and you're curious. Do you guys want to put in the chat, what's the capital gains tax rate? This is a loaded question in California. What's the top rate? Those of you that have been following it, it's 37.1, right? So you're single, you got, professional employee, tech worker, call it what you want. So actually, there is a situation where your long-term capital gains run into a 52% tax rate if you realize in this case, another 50K on the 300. So the point is, you think you're kind of realizing gains to a certain tax bracket. Okay, here's the brackets. All right, this is, we can sum them up. We're looking at cap gains here, but introduced phase outs. All right. So the phase out is where you lose a deduction. And so probably one you've heard about is the SALT deduction coming in to play. You get an extra $30,000 write-off. So if your AGI is just under 500K and you're single or married, you get that SALT deduction you heard about on the news. If your AGI is 600K, you have completely lost a $30,000 deduction. So what does that mean? That's called it's a 30%, 30 cents on the dollar loss of that deduction as you increase your AGI through this band here. So we can talk about more later. Just want to introduce you to the concept. Next thing is AMT. So this is what's really interesting. So AMT, I won't have time to explain it now, but there's an exemption. It's like a write-off in AMT that you get. Okay, so here we'll go back to the full screen. Single, you start to lose this write-off here. Okay, it's called an exemption. Okay, and you lose it at 25 cents on the dollar. Kind of like over here, you lost 30 cents on the dollar of a write-off. You got child tax credit, you lose 5 cents on the dollar. But if you add them up with a bunch of other things, so we'll just try to, again, you're not going to get this. I've tried to build this so I can explain it better, but here's what's happening with AMT that's not understood yet very well at all, is that these phase out regions get squished. So this whole phase out of your whole exemption, if you trigger AMT, and it's easy to, it'll take me, we can talk about it more later, but here's the thing, if you're single, you're either going to have a phase out because of the SALT that you lose, or if you're triggering AMT, you're going to have a 50 cents on the dollar phase out in this range right here. And so what does that mean? That means that when instead of having that 37.1% max, tax rate eventually, it's like as your income goes up here, you're looking at, you could be losing more than 50 cents on the dollar. So planning matters. You can be retired and pay zero taxes. You can make 151,000 of income, and you can actually pay AMT is for the funny thing. So the AMT actually gets triggered for someone who's married 65 plus with this type of an income example. So all right, I've checked the box. I explained it. Was I right? Did it not make sense, everybody? All right, so that's AMT. Any questions before we kick it into Q&A? All right, so wow, I'm so used to Jeff talking. It's like so quiet. All right, hey guys, so here's what we're gonna do. We're gonna stop the video recording, and maybe we'll come back for a closing, but I want to open it up to the audience to be able to ask questions of Jeff or of anything that we've covered here. So raise your hand if you have questions or put them in the chat. This is your chance. Resume recording.
The 30 seconds
right.
of oil and gas for a 10-year-old, with a caveat, for the first time, I have to say this is not investment advice. That's a registered security, so I have to be a little more careful. Oil and gas is another kind of tax advantage investment. You get a mix of tax benefits and returns. It has a very different profile compared to solar. The tax benefits are much smaller. Essentially, it's like a 90% deduction rather than all those credits and deductions. The difference is that with oil and gas, you get, at least in expectation, a much higher annual return because you own a big chunk of the oil and gas that's being produced by a well and then sold. This is, for most of our clients, the second stop after solar because the return profile is lower. It's still better than doing nothing for sure, but overall, as compared to just investing your money, paying your taxes and investing your money in the S&P or doing oil and gas, solar outperforms. The reason why you'd turn to oil and gas first or decide you don't want to do solar mostly comes down to something Jason just alluded to very quickly, which is that to qualify to use your solar benefits against your W-2, you need to be what's called a material participant, which means very, very shorthand here. There's a lot more to it, but shorthand is you have to spend 100 hours working actively in the solar business during the year that you claim the tax benefits. And with oil and gas, there's no such requirement. So if you're about set it and forget it, if you don't have the time, if you don't have the bandwidth, and you just want some tax benefits and some return, oil and gas can absolutely be a valid place to go. The returns are about 2x higher with solar, and so most people go there.
Awesome. Thanks, Jeff. Okay, so if you guys have questions, throw them in the chat. Let's turn it over to Paul. All right. Hey, I just want to say, thanks to Jeff and to Paul and Shang and basically everybody who's been involved in this event. Jeff's contact info you can find at the FinTrack page. I'll add Paul. I'll add your contact info there too, if that's cool. But yeah, reach out to anybody on here, ask questions. Ask who else is doing these. This is the kind of stuff where you kind of want to be able to talk to other people doing these deals. Very complicated, but not once you know all the rules. So there you have it. So, all right. Well, again, Jeff, thank you so much for coming back. Appreciate it.
Of course.
We do want to do another philanthropy event. We just, for the FinTrack, we just kind of want to make sure we got a good slate of volunteers. I think it's good. It could be a great one. So we will, you may be hearing from me again if you got time, but I know it's a busy time for you. So appreciate it. Paul, appreciate you sharing your wealth tech stack and your experience. Shang, always great to see you, buddy. I'm sure we'll be talking more this week, next week in general. So we'll get back to our other EBL hedge fund stuff, the simpler stuff that we love. But you can't beat those numbers that Paul threw out if it's a fit for you guys. So all right, well, thanks guys. Have a great day.
Appreciate it.